Good afternoon, dear traders. Finally, we come to the lesson that usually interests the audience the most. These are entry points. I understand that almost everyone wants to idealize and wants to get an algorithm that works without failures according to some given and understandable model. Let's show you picture 1. Sometimes such ideal situations occur. Let's take, for example, the pound versus dollar chart. There is an understandable break point in the trend from where the strong movement originated. Here you can see. Then there was a quick retest and a clear and understandable consolidation of the retest. Quick retest and consolidation, which allowed opening a sell position against the pound with a short stop-loss orders. Note that in this case everything happened even without false breakouts. Picture 2. Even we will move a little from the topic of the forex market so that you can see that it does not matter which instrument you trade. The important thing is to be able to read the graph and work with probability. Here is an example with the Russian stock market and Sberbank shares. At 239, there is false breakout option, and then at the exit from the retest range, and a false breakout of 248. You see, it's already more difficult than the previous example, and the market will periodically present such surprises. Therefore, it is worth understanding that the percentage of positive transactions may not even reach 30%, depending on your skills and discipline. Therefore, in this case, I again return you to the block of mathematics. Here you must lay a solid foundation. So, in this case, if we decompose the chart into components, first, here, movement stop and trend break point. Second, after the breakout, there is no continuation of the impulse, but so far the purchases are sluggish and worth their weight. 3. New sales below 236 again do not lead to active pressure. 4. We get real buying chances based on the analysis of the chart. 5. On retest, if at point 4 you showed caution, additional chances to open a buy position. 6. Retest of the past level 248, but already at the exit from the range 7, 8, and 9. Here, here, and here. False breakouts and an opportunity for entry. Here it is more likely that it would not have been possible to limit one deal and would have to re-enter after the received negative one. Okay, let's look next picture. Picture 3. Again, an example of the pound versus the dollar. Here there is a way out of the range. Long-term consolidation, and now there is no ideal picture, and the opportunity arises after a false breakdown. You see, long consolidation, false breakdown. That is, at the previous example, at the exit from the range, you would have to keep your finger on the pulse and re-enter to buy in time. Next picture. Another example that demonstrates how important self-control and discipline are in a technology index. And it is also traded on the Forex market. Here we see a clear and understandable breakpoint of the trend. Then an attempt to gain a foothold above the consolidation sufficient for an impulse. Here you can see consolidation and enough power to rise from here. But there is no upward impulse. The instrument closes below the level of 13,560. And this gives every reason to open a short position once again. Key point, instrument try to consolidate, no rise in impulse, and now price under resistance. Next picture. This is how the implementation looks in practice. Look at all that I said above, the breakpoint of the trend. Here. The attempt to sell does not lead to momentum and the possibility of entry. No sellers here, sellers pressure, and you have a clear possibility to buy here or here. Of course, when you combine all this with the global picture of the chart, volatility analysis, correlation with the volatility index, if necessary, look at oil and bond yields, then you get a more complete picture of probability. I hope you remember I showed this example at previous webinars, and I repeat it on purpose that you can consolidate the information received. Oil example, the zone from which the movement started, retest and consolidation again. The breakout attempt is unsuccessful, and this gives an opportunity for buying. Consolidation zone, then price return to the key level, no breakdown pressure, and here the opportunity to buy. Now you see how it all fits in with the global picture. On the daily chart, there is a powerful trend and a local correction. The weekly chart also shows an impressive trend and move and strong close from the previous week. What else do you need to be happy? Sometimes there are situations when you can open a position even before the level, if you read the chart well. Here is an example for SPY, ETF for S&P 500, where there is a clear support level and holding in the 336.50 36.75 area. What we see? Number one, first, the break point of the trend, while everything is going in favor of buyers. Second, we see where the sales are coming from, but there are still buy scenarios. 3. False breakout and return, and this is also in favor of buyers. 4. After a false breakout, a typical sluggish purchases and the price stops again at the selling point. You see, sluggish buy. Here, typically, you can see strong movement, strong impulse, buying pressure. And 5. Realizing that the instrument is weakening, the probability is somewhere equal to buy or sell, but most importantly, in the event of a breakout at 336.75, I get a good impulse movement due to the retreat of buyers. I decided to open a sell trade. So here I understand, if this level will break down, I have a real chances to get a good potential with according to my risk. So 6. Closing position based on the natural volatility of the instrument. And finally, one more example with a technology index that you can trade through your platform on the Forex market. Also, I made a deal to exit the consolidation. Already, for you, the logic is familiar and close. Consolidation, false breakout, and then a powerful impulse movement occurs on the news. You can see here. Strong consolidation, false breakout. Here I bought and realized this position. Okay. In general, everything that I wanted to tell you, showed you. I hope that you were able to grasp the logic, and this webinar will be useful for you and a good starting point for your first steps. I wish you professionalism above all, endurance and discipline. Step by step, strive for your goals and achieve them. All the best to you, and see you soon. Good afternoon, dear traders. The next block is statistical publications, news, and external background. Has it happened to you that you open leading television channels, hear that the market is positive, immediately buy, and the market suddenly turns? Or on the contrary, everyone shouts with one voice that everything is bad, but the market suddenly begins to buy back at high volumes? I think so. I was no exception. It seemed to me that if an authoritative publication says that the market is good, then why not buy it? Conversely, why try to your luck if they say that everything is bad? I remember one phrase by J.P. Morgan. that once Xu Shiner becomes interested in stocks, he must leave the stock market immediately. And his phrase remains relevant to these days. You need to think exclusively with your own head and implement your strategy, your vision of the market. Of course, the strategy should contain both mathematical and ideological advantages, and we talked about this in previous webinars. Therefore, no matter what reputable publications say, you must fully rely and trust your own analysis. And if your strategy says that purchases are interesting, then you are primarily interested in your analysis. Well, what if you are wrong? Then there is no one to blame, and here you are just working with a restriction on risk. For example, a stop-loss order as an admission that you are wrong. It is worth remembering that losses are part of the trading system. Remember the math block? It is not a single trade that determines the result, but the totality that express the mathematics of your trading system. Let me remind you again the percentage of positive trades, the depth of drawdown and risk, and the potential for risk that you take away in each trade. In this webinar, we will not dwell on each statistical element in detail. It will take hours of time, and there is enough information on the internet. Well, if suddenly you are interested in each of them, then we will hold a separate webinar on this topic. In this webinar, I want to focus on the main elements behind which the eyes of trading public are riveted. First of all, it should be noted that the shorter the time range for holding the position, the less the influence of fundamental factors, but only the reaction to the external background of the current day and the reaction to the published statistics. For an intraday trader, it is not the dynamics of statistics that is much more important, but how the market reacts at the moment. For example, does the market succumb to a panic on a negative publication on GDP, or is holding confidently, creating additional favorable probabilities for buying on a small correction? Or on the contrary, the market reacts weakly to the publication on positive news, and you see a clear resistance above which the market cannot step, and this is already prerequisite for becoming short. So, if we are trade in a long-term or medium-term framework, then statistics are important in dynamic. That is, where the market is looking and what expectations may be. It is not only the statistics themselves that are important, but also the accompanying factors. ISM manufacturing as an indicator that is ahead of GDP data. We can say that after the publication of ISM, GDP expectations are already in price. For example, let's look figure 1. We see an increase in the ISM manufacturing index, and it closely correlates with GDP. This correlation is over 60%. What do we see from ISM here? We see that it says that the next publication on GDP will be with growth. But we also see that the indicator reached 60, where the end of the cycle occurs. And quite possibly the end of the cycle will also happen this time. Of course, this will not happen all at once, and the accompanying factors must be taken into account. At this point, the allocation of additional money to the economy is discussed, which keeps the market from falling at the end of this cycle. But nevertheless, according to the graph you see now, that there is a reaction, downside reaction. If we switch to an intraday chart, a minute chart, then Now you see that it does not matter what happens on the foundation, and it is intraday that has its own reaction, allowing intraday traders to trade both long and short, depending on the situation and the market reaction. Additionally, it is also useful to look at construction data, durable goods orders, or personal expenses, or consumer income to learn about the state of the economy by sector. And all this is part of the GDP, and in one way or another is of interest for understanding the general picture, and especially if you are looking for certain ideas on stocks, weak or strong sectors. When the economy is growing and without problems, the reaction to the unemployment figures is likely to be restrained, or the market will ignore it. Since the difference between the previous values and expectations is not significant. But in cases of problems in the market, be it crisis or pandemic, the unemployment figures are of increased interest. This is logical. Imagine what would happen if, without financial and social assistance, half of the population was left without work. There will be a riot and possibly a revolution. Therefore, the authorities of any country closely monitor the level of unemployment. The employed are primarily people who received income and are able to spend money. And cash expenditure again are a component of GDP. You see how everything is interconnected. And here the claims for unemployment benefit are also an ISM leading indicator that allows you to estimate what the next report of the unemployment rate will be. We see that a few numbers with a decrease in initial jobless claims leads to a decrease in the unemployment rate from 14% at the highest of the pandemic to 6.7%. But this is far from ideal. And here we can again build assumptions that the regulator will intend to continue to stimulate the market until the level drops to its lows before the pandemic. But of course, almost any trader, and especially an investor, will be interested in the question, how long can they pump up the market and create the illusion of well-being? I must say right away that in the modern world, and it has always been so, politics and economics go hand in hand, and so that they do not talk about the free market and the invisible hand of Adam Smith. It should be understood that by the will of the natural life of the cycles, none of the politicians wants to fail. Let it be and others who follows him. These will be their problems. Alas, these are realities. But we see here that as a result, while inflation lows, it is possible to pump more and more money into the market, spurring growth and luring the population of any country in the race of prosperity. But so far, inflation allows. Let's look at this picture. Take a look here. We see in a longer term segment, which is published by the Michigan Institute, that inflation may well accelerate to 10% and quite higher, since there have not been such volumes of money injection in history. The first hints of the inflation will prompt the regulator to immediately raise interest rates in order to prevent hyperinflation and the fiasco of the entire economic system. the credit bubble will begin to burst, the cycle will end, and the stock market will immediately rush into a falling peak. That is why inflation is given special importance and attention in the analysis. This is exactly the incentive ceiling that could suddenly rise in the face of a bull market. But as I said, it will happen in time, not in the moment. Therefore, the difference in trading styles is essential for an investment manager and a trader in long-term positions. And for intraday trader who is interested in the market reaction here and now. So I hope that this short webinar without details on each indicator will be much more important and understandable for you than listening to a ton of information about anything. I wish you professional approach and development, and soon we will meet on the 6th video, which is usually the most interesting for traders. There are entry points and placing stop loss orders.